The 4% rule is supposed to be your retirement bulletproof vest. It is the safety net millions of people are trusting to protect their life savings for 30 years. But as we sit here in 2026, with the shadow war between Iran and Israel threatening to ignite the entire Middle East, that safety net is fraying. If this conflict shifts into a full-scale regional firestorm, the math protecting your retirement won't just bend. It will shatter years faster than the experts told you. And the scary part? Most retirement calculators are still running on 1990s logic. That doesn't account for the world we live in today. I've spent hundreds of hours analyzing how geopolitical shocks hijack financial markets, and today I'm going to show you the exact chain reaction. From oil shocks to cost push, inflation that turns a secure nest egg into a mathematical death spiral. By the end of this video, you'll have the war-proof blueprint to adjust your strategy, including the specific guardrail method that can save your portfolio from hitting zero. But first, you must understand why you were told to trust this rule in the first place, and the one massive assumption that makes it dangerous today. Point 1. The rule everyone trusts. Every retirement plan comes down to one terrifying question: how much can I spend without dying broke? If you withdraw too little, you sacrifice your best years. If you withdraw too much, you're 85 years old and out of cash. This is the exact problem the 4% rule was designed to solve. This rule was popularized by financial planner William Benjen in the 1990s. He studied decades of U.S. history, including the Great Depression. It's the gold standard. To use it, the math is simple. If you have $1 million portfolio, you take out $40,000 in year 1. If inflation is 3%, your year 2 check is $41,200. It sounds foolproof, but here is the crazy part that nobody talks about. The rule only works because of one massive assumption: that global energy remains stable, and the US market bounces back quickly from every shock. And right now, that assumption is staring at a 20-mile wide choke point in the Middle East. Point 2. Why energy shocks break retirement math. Most investors fear a tech bubble or a banking crash, but those are internal market problems. Geopolitical shocks are external. They hit the economy from the outside, like a sledgehammer. When the Middle East catches fire, the stock market doesn't just dip. The entire engine of global trade stalls. Roughly 20% of the world's oil supply flows through a narrow shipping route called the Strait of Hormuz. If tensions between Iran and Israel escalate into a regional conflict, that channel becomes a graveyard for shipping. Oil prices don't just go up, they gap up. This triggers cost-push inflation. Unlike the easy money inflation we've seen recently, this is a tax on every single product on Earth. Energy shocks make transportation, food, and manufacturing is more expensive overnight. For a retiree, this is a double whammy. Usually, when stocks fall, your bonds protect you. But during energy-driven inflation, stocks and bonds often crash at the same time. But here is the real reason retirees go broke in this scenario. It's not just about low returns. It's about a silent killer called sequence of returns risk. Point 3. The silent killer sequence of returns risk. Timing is everything. Two people can have the exact same 7% average return over 30 years. One dies wealthy, the other runs out of money in year 12. The only difference is the order of those returns. If the market crashes in the first 5 years of your retirement, the damage is often permanent. This is called sequence of returns risk. It means that bad market years early in retirement cause disproportionate damage. Because you are withdrawing money while your portfolio is bleeding, you are forced to sell more shares at lower prices just to pay your bills. Imagine you have $1 million. You take your $40,000. Suddenly, war breaks out, and the market drops 20%. You now have $800,000. But because oil prices spiked, inflation is now 7%. Your second-year withdrawal must increase to $43,000. You are now selling shares at the absolute bottom. those shares are gone forever. You've lost the fuel needed for the eventual recovery. This is the retirement death spiral. I once saw a portfolio lose 12 years of longevity because of one bad 18-month stretch at the very beginning. Point 4. The 1970s warning. We don't have to guess if this will happen. We've seen it before. During the 1973 oil crisis, oil prices quadrupled and inflation hit double digits. For anyone who retired in 1972 using the 4% rule, the math didn't hold up. Modern research suggests that during that era, the safe withdrawal rate wasn't 4%, it was closer to 2.8%. On a $1 million portfolio, that's a $12,000. It's the difference between a comfortable life and a decade of anxiety. And that leads us to the moment where the math truly collapses. Point 5. The climax. When the math collapses, the 4% rule assumes the market will eventually mean revert to 7 to 10% returns. But imagine a decade where global instability keeps market returns at a stagnant 3%, while war-driven inflation stays at 5%. If you are withdrawing 4% on top of that, your portfolio is effectively shrinking by 9% to 12% in real terms every single year. In that scenario, a 30-year plan hits zero in year 11. Not because you made a bad investment, but because the economic environment changed, and you didn't adapt. You used a peacetime strategy in a wartime economy. Point 6. The solution. How investors adapt. The solution isn't to abandon the 4% rule. It's to war-proof it. Smart investors use 3 specific adjustments to stay solvent when the world is in chaos. 1. The 24-month cash buffer. Keep 2 years of spending in a high-yield cash account. This allows you to stop selling stocks while they are down during a conflict. You live on cash and let your portfolio recover. 2. Dynamic guardrails. If the market drops more than 10%, you must skip your inflation adjustment for that year. This temporary pay cut can add a decade of life back to your portfolio. 3. Real asset tilt. Ensure at least 10% of your portfolio is in conflict assets, like energy stocks, commodities, or gold. These are the only assets that turn a geopolitical disaster. Sometimes the biggest threat to your retirement isn't the stock market, it's the map of the world. But wait, there's one retirement mistake that destroys portfolios even faster than a regional war, and 90% of investors are making it right now without even knowing it. Click this video on your screen right now to see the silent portfolio killer you need to fix before the next market opens.